again, really interesting concepts and ideas. We had him on 9 months ago. This was a different Raoul Pal to me, like similar in many respects, but definitely some different theses coming out of this episode versus the last one, and a totally different portfolio. What was your take here?
Yeah, it's really interesting to follow Raoul Pal down the crypto rabbit hole. I think that's why so many people enjoy the content that he makes, in addition to being just extremely articulate and extremely just informed about the way that markets work. We are all collectively watching Raoul Pal like discover crypto and formulate his own opinions. People kind of identify with crypto by the era in which they go down the crypto rabbit hole. And so we all get to watch Raoul Pal go down the rabbit hole late 2020, early 2021, and formulate his own opinions as what it's like to be in crypto in this specific part of crypto's history. Raoul is, of course, a big macro focused investor, which to me is a very like sobering perspective to take, right? It's like, let's ignore the regulatory FUD. Let's ignore the market movements of, 24 hours or 7-day charts or month.
Big trends.
Big trends only, trends only. And it's such a nice way to get clean signal from a very noisy industry. So that's always why I like to talk to Raoul Pal.
Yeah, totally agree. And I think Bankless listeners, if you have time, go check out the last episode we did with him in November. It's just a fantastic episode in and of itself, but it really shows kind of the things that have changed in his thinking, but also the things that have remained the same. I think one thing that's remained the same is he is data driven, right? Metcalfe's law is how he makes his decision. Network effects. He has to see the data on chain. He doesn't think about it too much, but he looks at the trends. And we got into that discussion. He also said this time, ETH is money. That's a big departure, because we asked him, because Bankless Platform has been saying that for a while. We asked him last time if he thought ETH was money. He didn't. But what changed is he started seeing NFTs purchased in ETH. And I think that's changed a little bit. He also gave us some ETH 2021 price predictions. He talked about how 1 billion people would be in crypto by 2024 if the current trajectory holds. He also gave us a peek into his portfolio. And last time it was 85% Bitcoin. Let's not reveal it though, David.
Right.
Last time
it's
it was
something
85%
else now,
Bitcoin, though. 15% ETH, and it is something else now. I will say he got rid of all of his gold, so you'll have to tune in to hear what his portfolio looks like this time around. All in all, man, I think Raoul gets it. He's not blinded by tribalism. He looks at this from a very analytical perspective, and he has a gift for simplifying things and distilling them to kind of base concepts that are very understandable and memeable. So huge respect. You guys are going to absolutely love this conversation.
Yeah. And let's just go ahead and get right into it. But before we do, we have to talk for a moment about some of these fantastic sponsors that make this show possible. Living a bankless life requires taking control of your own private keys, not your keys, not your crypto. That's why so many in the Bankless Nation already have their Ledger hardware wallets, which makes proper private key management a breeze. But the Ledger ecosystem is more than just a secure hardware wallet. Ledger is the combination of the Ledger hardware wallet and the Ledger Live app. And if you're used to seeing all of your crypto services and favorite dApps all in one place, Ledger is where you want to be. Not only does Ledger let you buy crypto assets straight from the app, but it also hooks into decentralized exchange aggregators like Paraswap, which makes sure that you are getting the best prices on your trades without your assets ever leaving your control. DeFi never stops growing, and the Ledger Live app grows alongside with it. So click the link in the show notes to see all the DeFi apps that Ledger Live has, and stay tuned as more and more apps come online. And if you don't have a Ledger hardware wallet, what are you even waiting for? Go to ledger.com, grab your Ledger, download Ledger Live, and get all of your dApps all in one place. Arbitrum is an Ethereum scaling solution that is going to completely change how we use DeFi. If you've been using Ethereum for the past 12 months, you've probably noticed the high gas fees and the slow confirmation times that have been plaguing DeFi. Too many people want to use Ethereum, and it doesn't have enough capacity for all of us. That's where Arbitrum comes in. Arbitrum is a layer 2 to Ethereum, which means Arbitrum can increase Ethereum's throughput by orders of magnitude at a fraction of the cost of what we are used to paying. When interacting with Arbitrum, you can get the performance of a centralized exchange while tapping into Ethereum's level of security and decentralization. This is why people are calling this Ethereum's broadband moment, where we get to add performance onto decentralization and security. If you're a developer and you want to save on gas costs and make an overall better experience for your users, go to developer.offchainlabs.com to get started building on Arbitrum. If you're a user, keep an eye out for your favorite DeFi apps building on Arbitrum. Arbitrum has been working with over 300 teams, including Ethereum's top infrastructure projects, and will be opening up to all users shortly. There are so many apps coming online to Arbitrum, so you may want to pack your bags in preparation for the great migration to the Arbitrum Layer 2. To keep up to speed with Arbitrum, follow them on Twitter at Arbitrum and join their Discord.
Bankless Nation, we are super excited to present our next guest to you. This is Raoul Pal. He's been on the podcast before. He is the founder of Real Vision. He's one of our favorite voices in the space, talking crypto, talking macro, talking investing in general. It's been about 9 months since we last had him on the Bankless podcast. That was November 2020. And oh my God, so much has happened since then. It feels like about 9 years. So we want an update. We want to unpack his brain, particularly on the events over the last 9 months and how he's thinking about markets today. Raoul, welcome back to Bankless. It's great to have you.
It's great to be here. 2 tropical storms and a power cut couldn't stop us doing this.
That's right. No one can stop us from doing this. We had to, for Bankless listeners, we had to reschedule this twice. We actually thought we were going to have to reschedule this time because as soon as Raoul jumped on our call, power went off. Electricity in the Caymans went off. How are you guys doing? Is this typical for the Caymans, Raoul?
No, it's not. It's actually a pretty stable place where everything works. It's just, for some reason, I mean, I've been here 7 years, and I've had 3 storms in 7 years, 2 of them within the last week. So either global warming is going exponential, or it's just unlucky.
Maybe just unlucky, but we feel lucky to have you back here, and we're glad we could actually have this conversation. You know, we thought we could do sort of a rundown of topics, Raoul, and just pick your brain on them. So we want to talk ETH, we want to talk DeFi, we want to talk NFTs in the metaverse and everything that's going on. We want to contrast that with our conversation 9 months ago. But I thought what we could do is go from sort of top to bottom, big to small, if you will. Okay. And let's start with sort of the macro. And take us back 9 months ago. What's changed in the macro world over the last 9 months? Give us the update there.
So what basically happened? So 9 months ago, let's say we were talking about May, June last year, that my macro thesis at the time was that we were going to see some sort of insolvency phase, the overhang from this whole situation. That didn't happen because of the unprecedented amount of monetary printing that went on and the ongoing fiscal stimuluses. So then we look back and we realize that the worst recession in all recorded history only lasted 2 months. And that was all about, again, this stimulus. So if you are Janet Yellen and Jay Powell, you sit in a room together and go, that was pretty good, eh? It kind of worked. It worked for the financial crisis, and now it worked for the entire world closing down. Maybe we don't have to have a business cycle. Maybe we don't have to have risk anymore. So the marginal propensity for them to fire that gun again is extremely high. Well, the market sells off. Well, let's just add some stimulus. You know, we're still not sure that equality is quite right. We'll add some stimulus. Every answer becomes we can add stimulus. So the market currently has been looking for strong growth, and Jay Powell was out today talking about potentially tapering because the growth numbers have been strong. But my work suggests that the economy is actually weakening. So China has a weak credit cycle and its GDP growth is falling sharply. Japan has got itself in a huge mess now with the COVID Delta variant. That's the 3rd largest economy in the world. And, you know, Europe still stop-start. The US still not fully recovered. And it's normal. Normally it takes maybe 2 years to fully recover from a recession. And this was a big one. So after we call the end of a recession, generally the central bank cuts twice again after it because growth isn't fully stabilized. So we're in this phase where growth, I think, is starting to weaken. We see it in things like, the most dramatic being the University of Michigan sentiment surveys for buying climates of houses and cars and big ticket items. People have just gone, this is the worst buying climate we've ever seen. It's the worst numbers we've ever seen in these surveys because of the price rises that came from the supply shocks beforehand. We see rollover in ISM and these other business cycle surveys. So we're going into a period where the Fed are talking about tapering. The market really thinks inflation is the big enemy, and probably we're about to see a slowdown. Now, knowing that every single recession since 1962, the Fed cut rates twice after it, and we saw this little spike in bond yields first, and then bond yields went back to the all-time low almost every time since 1990 for sure. So the probability is for me that the economy's weakening, the Fed cut again twice. There's probably more fiscal stimulus to come, and the markets haven't priced this in at all. Now, in the context of what does that do for asset prices? Well, I've talked to a lot about the significance of this printing. It doesn't come up in CPI, the inflation that everybody talks about. It comes in the fall of the value of fiat currency, the denominator. And we see that because basically you can divide any asset by the Fed balance sheet and everything's about flat. And you can do the same with German property and the ECB balance sheet, or UK property and the Bank of England balance sheet, or Swedish property. It works pretty much consistently. We're lowering the value of fiat currency overall. So if the Fed are going to do that, we should see a rise in the value of equities, the value of real estate, most assets, and especially cryptocurrency.
So your take is we're going to continue to see asset price inflation, but what about CPI inflation? I mean, there's definitely been murmurs of that. Of course, we hear from some of the Fed and economists that it's just transient, it's not permanent. Others say no, this is going to be more pernicious. It may go down and up in cycles, but the trajectory over the next 5 to 10 years is going to be up from a CPI perspective. What's your take on CPI inflation?
My big picture take on CPI inflation is almost impossible to make it go up. We have the baby boom generation who are now 70 and they're all retiring. So their consumption pattern falls significantly. And we've just seen over the last year, the largest wave of retirees in all recorded history. And those people, once they retire, spend less money because actually their pot of final savings is not that big. But the ones that are still in the labor force are competing with their kids, the millennials. So you've got the two largest cohorts in all recorded history competing for jobs. Then we've got globalization. So if it's not bad enough competing against your parents, you're competing against Chinese and Indians. And if that's not good enough, you're all competing against the robots and AI. So that backdrop is, and in a massive credit bubble. So that backdrop is wildly, wildly disinflationary. The relentless rise of technology is hugely disinflationary. So can you generate CPI inflation? I don't think you can. You can't generate it in food because technology just destroys it because crop yields keep going up, price of food keeps falling. You can't do it in basic stuff like clothing and furniture, none of that stuff, because technology keeps changing. You 3D print tables and chairs now, it requires no humans. You can do it just-in-time technology, need no inventory. And this is relentless. The only three things that went up over periods of time, one was housing, which we're aware of.
Another asset, of course.
Yeah, but rents have gone up as well. So
right.
that's not been easy. Healthcare. Well, no shit, Sherlock. If you've got 76 million baby boomers at 70 years old, they're competing for healthcare. So the costs go up, and that will continue. The other one was education, but that's collapsed, the rate of inflation, because the entire millennial cohort has now left university, pretty much. I think they're all out now. So I think it's Gen Z in university. So the cost, the marginal consumption of education has gone down. So I find it very hard to see this. Now, are you going to be able to keep the price of copper and industrial materials high? Copper, maybe because of the electricity boom that's coming. But overall technology lowers the price of copper. You can extract more copper. We saw that with fracking and oil. That's technology. That's how technology stops price rises. That's probably the best example in the world is, you cannot keep the price of oil higher because technology keeps dropping it lower. So no, I don't believe in CPI.
That is a good example. So this is kind of a mental model buster, I guess, for me. So my model of things, or my best guess going into this, was like, hey, over the last 10 years, we sort of saw the asset price story, an asset price inflation story, right? Ever since 2008, kind of, Fed printing, money supply increasing, eventually it's going to asset prices. I mean, you're kind of saying, and then in my mind, I sort of thought, well, the next 10 years might play out, and some of that asset price inflation might sort of seep into CPI and become, more pernicious. But you're saying like the next 10 years might actually turn out to be similar to the previous 10 years. We just get some increasing asset price inflation even more.
The truth is, wages in real terms in the United States have not gone up since 1974 in any meaningful way. So they've underperformed almost everything. So what that means is your wages, your income has remained static while the cost of assets has gone up. So you're actually poorer. What is that? Why? What is an asset? An asset is delayed consumption. You put your money into the asset, and in 20 years' time, you sell the asset and you spend the money. Right? That's the point of owning assets. They're delayed consumption. What it means is your future self has now got a lot poorer because this stuff keeps going up faster than your wages. This is the real dramatic problem. That equation of can you get wages up to create demand push inflation? No. Can certain cohorts' wages go up? Sure. But overall, you can't, because everybody in Silicon Valley's job is to drive costs lower. And it's a really dramatic situation. This creates a huge amount of anxiety, social anxiety. People don't know why they're getting screwed, but they're getting screwed. And it's not just the Fed raising asset prices. It's actually the fault is of the silent generation who had too many kids after World War II. That's, if you want to blame somebody, and World War II was a feature of World War I because they didn't pay they refused to allow the Germans to forgive their debts. So it's a long story of how we got here, but it's not going to change.
We're all paying for the sins of our fathers, I guess, probably while committing new sins without knowing it, that future generations
that's right.
will reap.
You don't know the law of unintended consequences. I mean, nobody thought that this is what would happen. Is after the euphoria of World War II, 70 years later, you'd create a massive collapse in growth, which has happened in Europe, Japan, everywhere else that had post-World War II economies. They all did the same. The others are slightly older because they had a lower rate of immigration than the United States did. And what happened was they all started, their economies started slowing down faster than the US. But it's baked in the cake. It's difficult to avoid, almost impossible.
So that's the macro story. Now let's maybe burrow another layer deeper here, but still related. I know you've had a thesis, Raul, that's basically like macro and crypto. Those two things will converge. That's going to become one and the same thing. It's a fast convergence, but people might not see it coming. What have we seen over the last 9 months in the macro story of crypto? Has there been more of that convergence? Are they now close to one and the same, or what's changed?
So I think they're the same. So if I go to my peer group and the people I really respect from macro hedge fund space, right? So that's the pointy end of macro. Those are the guys. Almost all of them have transitioned across in one way, shape, or form, either entirely or partially.
Really?
So, I mean, very
is that like
famous.
The last 9 months, or how long?
It's been happening slowly, but it's increasing. It's going exponential as all these trends do. So, people like Alan Howard, who's one of the world's most famous macro investors, based out of the UK, he personally is entirely crypto now. Dan Tapiero, good friend of mine, he's entirely crypto now. I'm pretty much entirely crypto. Certainly my investments are. I still look at them whole macro world. But one after the other, they're all seeing the superior returns and a solution for the set of macro problems. So macro guys generally tend to be pretty pragmatic. We've got a set of problems, solutions, what's going to make money, allocate capital accordingly. But everybody's going, well, this is the biggest opportunity we've ever seen, because everybody starts on the Bitcoin journey and ends up having the holy shit moment that everything is about to change. And I'm sure we'll talk about a lot of that later. So I think macro and crypto have merged. What you're seeing now is you're seeing a lot of noise from the latecomers to macro. People who only know either the latecomers from macro or the ones that have been around very long and are anchored to gold and certain kind of mean reverting ideas. What you're seeing is a fear of change. So the noise that you're getting at the periphery, the Peter Schiffs of this world, for example, is not that Peter Schiff doesn't understand that crypto is the future. It's that he doesn't want it to be, because it's technology. It's fast.
We call that bag bias. Is that what you're saying?
It's actually worse than bag bias. It's a fear of change, right? We're going through the fastest change in all history. So for people to understand what I'm talking about, the internet grew at 63% a year from 1990 to 2000. The internet was 140 million users at 1997-ish. Crypto is about the same now. But the crypto digital asset space is growing at 113% a year. This is the fastest adoption of any technology in all recorded history. People don't want to believe it. How can my very system of money change in front of my eyes? What does the central bank mean any longer? What does it mean for my savings? What does it mean for, the thing that I've railed about all the time is gold, that'll save you from all of this. And now there's something else. Everyone has to drop so much of their kind of outward facing belief system. And it's hard. So that will slowly change over time. But generally, the macro people who are broad-minded have entirely changed.
Raul, I want to get more and more granular as this conversation goes on into some of the nitty-gritty details about what's going on in the world of crypto. But before we do that, I want to just emphasize the role of the macro perspective when using that perspective to actually understand what's going on when we get to those nitty-gritty details like NFTs and metaverse and whatever. And so let's just keep going on this. What is so powerful about the macro perspective, and what properties about Bitcoin, Ethereum, and crypto make this obviously a macro conversation? Right?
Yeah,
like you talk about internet adoption, you talk about like network effects and Metcalfe laws. Like why does the properties of crypto so neatly fit into a macro perspective?
The easiest way of explaining it is by my journey. How did I get here? And my journey was I was macro for 30 years. It was 1997 where the world changed. 97 and 98 was the Asian crisis. The Asian crisis was a sovereign debt crisis and a corporate debt crisis that wiped off the value of Asian stock markets by 90%. Currencies collapsed 80%. It was a total wipeout of wealth in Asia. And it was driven by debt. The answer to 1997 and 98 was to cut interest rates. Long-term capital management, the giant hedge fund, blew up at that time as well. The answer to that, because it could have taken down the financial system, was to cut rates. That led to, firstly, a massive rally in equities and pouring of money into the internet boom. So that was a VC-led rally plus all the stocks. That obviously ends up morphing into where we are today. Crypto could not have happened without the internet. But what happened over that period is a massive debt bubble in property. So the debt bubble continued. It, in fact, accelerated. Then it blew up the entire world's banking system in 2008. Nobody knew who'd owned what. So when Lehman went under, everyone's like, well, I don't know. How do I get my stuff back? And they're like, well, it's not your stuff. It's been rehypothecated 37 times. So you can fight it out in courts. And, oh, by the way, it's held in the Cayman Islands, London, New York, and Hong Kong. Figure it out yourselves, right? That was the mess we got into. And people got wiped out. Then we cut interest rates to zero and invented quantitative easing, which the Japanese had been kind of trialing beforehand. So now we're pushing money into the banking system and we have rates at zero. And so humans being humans go, well, great, we'll just borrow more money. And they just keep borrowing money. So all of us in macro have been watching this and talking about it for a long time, 20 years, long time. And we knew, business cycles only come along once every 5 to 8 years. And it all comes to a head in a recession. So 2008, you kind of knew was coming because of what had happened in 2000 and what had happened in 97. And the piper was going to get paid. And the central bank figured a way out of it. Then suddenly, this event happens last year. There was going to be a recession, but the accelerant was the pandemic. So it blows up everything. And the world could have blown up again, right? Everybody should have gone insolvent because the world shut down for a year. But the government just said, no, here, take free money and the central bank will just print it. So we now know what it's doing to the value of our savings because these assets are going up. We're actually getting poorer in our future selves. And so the macro guys start thinking, well, how the hell are we going to get out of this cycle? It's either going to blow up spectacularly, but the odds are getting less, or we're just going to get poorer slowly over time. So it's a matter of how fast you figure out what's going on. So once you figure out what's going on, you look at crypto and it solves a lot of this. So when Bitcoin first comes along, it's clear it's developed solely for this job. I mean, it's very clear in the white paper, and it's very clear when they're looking at the banks being bailed out again, that somebody figures out, why don't we try a scarce digital asset and see if that works? And then about a year or two after that, people start figuring out, oh, blockchain. Oh, that kind of is interesting, but other stuff, because we've got now a trusted ownership structure, which the world didn't have. Then Europe blows up in 2012 as well. We almost lost the whole of the European Union and all of the banks. So we kind of know it's a big problem. And then Ethereum comes along with smart contracts. And then the kind of light bulb moment for everybody goes off is like, actually, we can rebuild the entire system from scratch. So as a macro guy, when you know you've got something fundamentally broken and there's only one set of outcomes, which is printing more money, we've got this low growth from this demographics and technology and all of these things that have been changing the world. So we've got low growth, massive debt, makes it hard to service the debt, increases the amount of printing. So therefore, these assets go up. But the real macro opportunity is to invest in the new world. We've just discovered the Americas from scratch. Why would you not buy that? Because it actually answers all of the problems. It's got the scarcity, it's got the ownership, the transference. It's a new system. It doesn't have the fragilities of the old system. And then the macro story gets better because it's like, if you remember, go back 9 months, go back maybe 18 months, I was like, we need a yield curve. 4 months later, DeFi explodes. And it's kind of there's different yield curves everywhere and different risk curves and God knows what. And then ETH and staking comes along and we've now got a risk-free yield. I mean, we've got everything we need. So this becomes a macro bet now. So how do you analyze a macro bet? Because for me, I can't understand all of the protocols, or, look at every single token, think about everything. So you need a framework, a macro framework. We need to simplify it. And so I spent a lot of time around kind of November last year, October last year, looking at the pushback people would give you in social media when you talked about Ethereum. And the Bitcoin guys would hate you, right?
Right. Mm-hmm.
Yeah. So I remember when you came on in November, and one of the big, I could tell one of the big areas of interest for you at the time, Raul, was like tribalism. Because I think you were seeing all of the tribalism in crypto and being like, why can't everyone just get along?
Mm-hmm.
But that tribalism forced me to understand when I get these kind of pushbacks, right? So we talked about it before, the kind of gold crowd. Why do they push back? I don't get pissed off with them for pushing back. I try and understand why. What is the motivator? And then once you understand what it is, it's a much easier thing to deal with and also to reason with people. And this Bitcoin pushback about Ethereum, I was like, what is going on here? And, we know all the stories of why, but they all had reasons why Ethereum was not the same as Bitcoin. And it's obviously clearly not as an asset, right? It's a very different thing. But why would you not look at it the same way? All equities you kind of look at the same way, and all fixed income you do. And so why would you not? So then I just dusted off Metcalfe's law and realized that it fitted perfectly. It was absolutely perfect. And in fact, it matched exactly where Bitcoin was when it had the same number of wallet addresses. And it was like, oh my God, it's the same price as well. And then I realized the whole damn space was this. So then it was just a matter of adoption. I didn't have to be the guy in the weeds understanding everything. I just need to understand how fast the adoption was. And when we're talking about adoption, there's two ways we need to think about it. One is investors in it. So we can see Doge, for example, classic example of a one-side network effect. So price goes up because a bunch of investors, but if they go, it would all disappear. But Ethereum clearly had more developers working on it than any other ecosystem, and that was growing, the rate of change of that, and the number of applications. So now you've got this kind of perfect storm of network effects. And that helps me understand stuff like Doge as well. I mean, people are like, this is a scam, blah, blah, blah. I'm like, no, it's not. If you've got $40 billion of value in it from investors alone, then all somebody needs to do is figure out the other side. And you've got a massive network. And the first person to do that was actually Mark Cuban. Mark said, fine, you can use Doge at Dallas Mavs. And then Elon had seen it as well. And clearly he's working on something to do with it, whether it's streaming car payments or whatever it's going to be. It's very clear that it's going to be used. And that's fine because you become less cynical about what these things are and you can judge everything by, is it a real network effect or not? And that's made the space much more investable, much more macro, much more understandable, and much less tribal.
Absolutely. And there's this division in the crypto industry where people like to either perceive these things as monetary units or financial assets or technology. And we on Bankless, we like to think these things as both, whereas Bitcoiners like to perceive these things as more, it's a means to an end to produce a financial unit. And there's other like platforms that are really all about the technology. But over the last 9 months, and since we last synced with you about what you were thinking about, it was largely all about the macro, the whole money printing, the trustlessness of the assets. But recently, I've been noticing you talk more and more about like the network effects of the adoption of Ethereum. So when you see the rate of adoption of Ethereum, do you perceive that as like a technological adoption or an adoption of the nature of the assets on Ethereum? Or is it really just one and the same?
Well, what's so interesting about Ethereum, it's everything. Mm-hmm. You know, I actually bought my first NFT today. And look, everything's priced in.
Congrats. Was it a CryptoPunk?
You got to tell us more about that, Raul.
Yeah, it's nothing exciting. I just thought I'd have to do it. We'll come on to that when we talk about NFTs in a bit. But it was priced at 0.75 ETH. Mm-hmm. So ETH is money. And I'd seen that because we commissioned for Real Vision a kind of headquarters in Crypto Voxels, which we're going to release soon, just for the fun of it. And the architects, we paid in ETH, and the land we paid in ETH. So it's like, okay, well, ETH is clearly money, but ETH is technology. We know that too. ETH is also a platform of which people are building a lot of different applications. So whether we talk about community tokens, NFTs, DeFi, a whole bunch of stuff, DAOs, they're all going to be on ETH. Now, will ETH be the only chain? No. Clearly, people use Solana for stuff, and there'll be a multi-chain world of which there'll be a few giants and a long tail of stuff. And that's pretty normal. But ETH has got really interesting because of this. And then, I came out with a piece in Global Macro Investor last month called The Greatest Trade. And, here's my macro head on again is, okay, we've got this adoption that is kind of exponential, right? It's growing at least twice the rate of Bitcoin. And it's by far dwarfing the rest of the space. Then the EIP 1559 comes along and that reduces the supply. So that's clearly bullish for the price. And then you look at the on-chain analytics and everyone is bloody staking it because now it's a pretty clear run between now and ETH 2.0. So why would you not if you're a long-term holder? So everybody's staking it. So that's taken a ton of stuff off the exchange. There's tons that have gone into just holding, tons that are locked up in DeFi, tons that are locked up in NFTs. And you're left with, I don't know, as of today, 11% of the entire supply of Ethereum available, and it's going down every day. And the demand is going exponential. The only outcome is an exponential rise in price. There's no other outcome.
Raoul Paul, you are an ETH bull, my friend. This is something that I think we've been talking about on Bankless for a while, right? But I think a lot of people haven't seen it until because there's execution risk, right? I mean, we've been talking about EIP 1559 for 3 years, but it's like everyone's like, yeah, well, is it there? When's it coming? What's the timeline for this? Now things are happening and people are starting to see it. I want to talk more about ETH as the greatest trade in a second, because I want to hear kind of your full bull case. But before we do, just doubling back to, I think, a key point of interest for Bankless listeners, because every